Did you know that our investors at Real Wealth are getting loans at 4.75%? And that is on investment property. A lot of people think that's impossible, but I'm here to tell you it is possible.
What's up, guys? Welcome to another episode of Invest Iowa. Today,
we are here with
the pleasure of
we are Kathy Fettke. She is a real estate investor, and she's going to give us threats and trends to be aware of in the real estate market.
How can we get it started? Thank you so much for coming.
Thank you. Happy to be here.
Yeah. So tell me a little bit about your day. Like, what are you working on currently? What's going on in your brain?
Oh, well, it's times like this where you got to get busy, because when there's fear in the air, that's when there's the opportunity. So, a lot of people thought last year was the opportunity, and the masses dove into buying property thinking that cycle would never end. But having been through many cycles, I know what's usually after that. And it's usually the time to buy when people are fearful. And that's what we have right now. You've got headlines predicting a housing crash. Of course, they've been doing that for 10 years now, and it hasn't happened because they're not really looking at the fundamentals. But when headlines are scaring people, that's the time to get busy, and that's what we're doing. I have a single family rental fund that we launched. We're buying properties in the North Dallas area where there's tremendous growth, but there is almost no competition. So we're getting properties for like, oh my gosh, 40% discounts, simply because there's so much fear in the air, and the lack of ability of a lot of people to afford properties. So if you do have cash or you have a means to acquire, you can get phenomenal deals. So we're focused on that single family rental fund, and we're also helping investors. We have a national brokerage where we help people buy investment property with teams that we've relied on for 10 years. That have property management in place and really look for what would be a great investment.
And so those aren't flips; those are midterm, short-term, long-term rentals.
Buy and hold, rentals, cash flow.
Buy and hold, okay. That's
all like
12-month
leases, no midterm rentals, or
we're super boring. We just do the old traditional stuff. We know that there's families who would love to own a home but are not in a position today, especially with today's interest rates, but they're forming families. We have the largest generation in history, the millennial generation, that's at household formation age. There was a lot of really stupid headlines saying that the millennials were somehow different than other generations, and they were not getting married and not having babies. Well, they were like 20, so I don't think they were ready for that. But now the largest section of millennials is between 29 and 34, which is exactly when they get married and have children and animals and would like to have a yard and a home. Unfortunately, a lot of them will be forced to rent. So we just, that's the business we're in, is the buy and hold, to sort of buy and forget about it type property. So it's more passive.
And we're looking at single family houses, right?
1 to 4 units. Yeah. I mean, I still like that because of the financing that you could get for 1 to 4. It's still conventional. And like I said at the beginning, we're still finding opportunities to get interest rates below 5%.
Wow. And is that because it's not multifamily and because it's conventional?
It's because of our relationships. We have negotiated with sellers to pay points to buy down those rates, because they know that people within Real Wealth they're wanting to hold these properties, and they want lower debt. They want lower cost debt. So when you're in a situation where, sellers, just a year ago, sellers could call the shots. It was a seller's market. They could say, we're going to list this house, do nothing to it. You have to fix it, and still going to get 20 to 80 offers or whatever, depending on the market. That's not the case today. It's turned where it's a buyer's market. The buyer has the power. So the buyer can now go to the seller and say, look, I'd love to buy this home, but you're going to have to put in some concessions. And maybe some of those concessions would be, you're going to pay a little extra money to buy down my rate.
So are those adjustable rates or those fixed rates that you're
fixed?
Okay.
Fixed. Mm-hmm.
What are the challenges right now that you're having with the 1 to 4 units that you're talking about? Like, what stands out from a year before, COVID area, when it was a buyer's market, a seller's market?
Well, again, at Real Wealth, we're this is our time. This is the time we've been waiting for. A year ago, we were competing with everyone. We were competing with first-time home buyers, with institutional investors, with fund managers, with flippers, wholesalers. It was a frenzy. It was really hard to come in and get any kind of deal. Now you go, fast forward to a year from now, most of those people have left the table. It's kind of hard to flip property right now. It's a little bit institutional investors have backed off a bit. And obviously first-time home buyers are really stretched. They're not in a position to be able to afford the payment. It's gone up 40% in some areas with interest rates going up. So this is our market. We're busier than ever. This is the time to buy, to get the asset that's in so much demand at a discount and be able to cash flow with that.
What's the demand mean to you on a national basis?
Every market is so different. There are markets, when the national news comes out, what are you trying to do? Take the average of certain cities and make that a number that means anything to anybody? That would be like saying, I'm going to go skiing in Alaska, but I need to know what the temperature is in Phoenix and average it out. Like it doesn't matter. What matters is where you're going and what you're trying to do. So if you were trying to buy in Phoenix right now, that's a market that's pretty oversaturated. There's the prices have come down quite a lot. There's a lot of inventory on the market. However, depending on who you are and what you're trying to do, that could be a good thing because prices are lower and you can negotiate. Boise, we've seen, prices come down as well, San Francisco, but in areas where we focus, which is, Florida, Texas, the Carolinas, Alabama, really the Southeast, this is where the demographics are headed. There's more demographic growth in the Southeast than anywhere in the country. That's where we're focused, and we're not seeing prices come down there at all, but we're seeing less competition. So we're getting better deals, even though prices haven't really come down. But like I said, in my single family rental fund, we're buying stuff that needs work, and banks don't tend to want to lend on properties that need work. So if we're paying cash, we can get even extra big discounts. Like I said, 40%.
When do you think investors are going to start catching up on these trends that you're trying to hop on?
The investors I know are fully in on it. We're busier than ever. We had the highest sales just last month because mortgages came down a bit, and with the rate buy down, they're just getting great deals. So at Real Wealth, we're not seeing a slowdown. We're seeing tremendous investor activity. But as far as the institutional investors, they have a different, they have a different system because they rely on what their investors want, and they are looking at commercial loans. And commercial loans are really challenged right now. I would say if there's one thing that is facing the biggest challenge, it would be the commercial industry, specifically office, of course. As more and more people are working from home, office space is getting hit so hard. But you have a lot of syndicators that came recently into the market that don't have a lot of experience, didn't really understand market cycles, kind of expected that rents would continue to rise, didn't realize that floating rate debt or adjustable rate, debt would change, that it wasn't going to be 2 or 3% for very long, that was a pandemic related interest rate. And so a lot of these new syndicators just didn't understand that was going to change, and that would absolutely and dramatically change the return, and in some cases force them to bring more money to the table that they don't have, or refinance into a higher rate that they just aren't going to be able to do. So that's a threat today to people in those products, but investors, potentially wanting to get into, commercial real estate may find some good deals coming up soon.
So I have 2 following up questions to what you just mentioned. So you briefly talked about buying points, right? Could you give a brief description of what that is and how you benefit from that in your business?
Yeah, absolutely. So let's say on an investment property, you're quoted 7% or something as your interest rate on a 30-year, 6.5% on a 5 or a 10-year fixed. You could go to the seller and say, I want, a seller concession where you pay, you pay what the lender would want to buy down that rate to 6%, or in the case I mentioned, down to 5%. Basically, lenders are saying, we'll lower the interest rate if you pay us a chunk of money, right? Pay us up front, because most people don't stick with their loans forever. They will refi, or they will sell the property. Generally, people hold their mortgages for less than 10 years because there's a constant refinance or sale that happens.
Yeah.
So the lender just wants to make sure they're going to get paid. And if that means, hey, we'll lower the rate for a little bit, we know you're going to refi eventually, but we just want to get paid that money up front, they're willing to do that. And so if you can get the seller to pay that for you, which you can, because they're trying to move properties, properties are sitting on the market for longer, then you can lock in a 5, 7, or 10 year at a much lower rate if the seller pays those points.
And then my follow-up question was, with all the involvement of the Fed recently, up and down, I know this is a daily topic for you and for everybody that is involved in the real estate. What are your thoughts on that? Where do you think that's going to go?
So the Fed has been really clear about where they're going, and I don't know why there's so much chit chat about it. They have absolutely told us for a year now what they're going to do, and people still question it. But a year ago, the Fed, came to the table way too late in raising rates. They were stimulating the economy after the pandemic, which was needed at the beginning, but they went too hard, too fast, too long, and overstimulated the economy, creating inflation, as we all know. So in order to stop that, they have to slow down the economy. They revved it up by printing almost, $7 trillion. They created over 40% of the currency that was in circulation.
I heard they made more money during COVID than they had in the past 20 years combined. That was mind-boggling to me.
No, it is. I mean, in 2007 alone, there was the amount of money that was in circulation in 2007 is what was created in during the pandemic. So
it's wild.
It's crazy, and somehow they thought that wouldn't create inflation, which again makes no sense. But those of us who understand that if you print more money but don't increase the supply, you're going to create inflation. So at a time when businesses were shut down and builders couldn't build and manufacturing couldn't happen and people had to stay at home, they increased the money supply. And when basically inflation is too much money chasing too few goods. So they shut down all the businesses, but threw all this fake money out there.
Yeah.
Of course, that created massive inflation that they had to pull back on. So then they went dramatic, and they made it really clear a year ago, we're going to have to go hard on this. We're going to have to raise interest rates 7 times. They said that a year ago, and people still every month, oh, are they going to raise rates? Are they going to raise rates? Yes, they're going to raise rates. They've said it. They're going to do it 7 times. They did. Now this year, and they kept saying we're going to raise rates till we get up to about 5.25. They're not there yet. So anyone who thinks that, oh, they're going to slow down, they're not. They made it really clear where they're headed. They're fighting inflation. The inflation that they created, they're now fighting, and they're fighting it aggressively, and they're not done.
I got another quick question for you. In the beginning, you said a lot of people have been predicting the crash for about a decade now. And a lot of people haven't been through cycles. I haven't. I bought my first rental in 2016, so I've been doing this 7 years, never been through a cycle yet. But you said they're not looking at the correct factors to be able to make an educated assumption that the market is going to crash. You said you knew what you were, or you should be looking at, and that's why we're in that now. What are those factors that you're being aware of to now know and have a more educated stance that, yeah, no, we're really going into a recession right now?
That is a great question.
Thank you.
I was going to say the same.
Yeah, no, I love that question. And actually, shockingly, people don't ask that enough. So we are going into a recession. That's almost certain. The Fed is trying. We may be in one right now because they are trying their darndest to create one. And if your government's trying to create a recession, you're probably going to get one. And with the banking crisis, we already know there's a lot of trouble out there. We just got the jobs report today, and while there was job creation, it's still the Fed's actions are working. Basically, when the Fed lowers rates, that makes money cheap and people go out and spend.
Yep.
So if you were saying, hey, you know what, I want to buy a new car. I got a car, but I think I want to buy a new car. And the interest rates are 1 or 2% and your payment is $500 and you can afford that, you're going to just go buy a new car. And when you buy a new car, the bank creates that money out of thin air. That's the way our system works. They just create the money, and that's part of how there was so much money in circulation. Now, when the Fed raises rates and now your interest rate is 7% and your payment now is $1,000, not 500, you might just not buy that car, which means you'll keep your car, which means that transaction didn't happen and the salesperson didn't get their commission and the money wasn't created. That is what slows down the economy. So during the pandemic, the Fed was trying to stimulate things, so they brought the interest rates down to near zero. You know, the overnight lending rates, which when banks do mortgages, it's usually like 3% higher than that. So if the overnight lending rate zero, banks are going to do their margin at 3%. That's why mortgage rates were so low. But now, you know, now they overdid it and everything costs more. So coming back to your question again, which was so good, how do you prepare for something like this?
Factors do you focus on?
Yeah, and what factors? We definitely know we're going into a recession, and the Fed is trying to get people to lose their jobs. So sad, right? Such a dumb way to do things, but that's what they're trying to do. It hasn't worked. Job creation keeps happening. But what do you do to prepare yourself? That's the question. Now, we're real estate investors. I assume that's your audience. That's what I am, and that's my audience. Does the fact that there would be a recession affect us? And that's what matters. So when you look at, for instance, what I do, which is buy and hold real estate, I provide rental property, affordable rental property to families. That's my business. So I need to look at how this recession would affect me and what I'm doing. What we know is that demographics are telling us there is a massive, massive generation of millennials that are having babies and they're getting married. They have animals and they want a place to live. It used to be this old idea that millennials are just going to sleep on the couch of their parents' house or in the basement. Like, no, that is not what's happening. You have a very large population in need of housing. The supply has not been created. It's been very, very difficult to build new homes. I'm in the home building business. It's been rough. We couldn't get the materials we needed. Those materials cost more money. So the supply has not been created right at a time when the demand is insane. If you go back to the Great Recession in 2008, you had the Gen X population that was at home buying and household formation age. That was a small, much smaller generation, and yet there was so much more inventory. That's when builders were going crazy because they could get easy access to money and just build. So at the time, there was about over 3 million homes available on the market with a much smaller generation of people buying them. You fast forward to today, you've got less than 1 million homes on the market and a much bigger
Buying pool
population. So you cannot compare the two. You've got not the inventory, not the supply, with tremendous demand. So that demand isn't going to just disappear. They have to find a place to live. And that place to live is going to be either an apartment or a rental property, or they're going to buy a home. Now, every time mortgage rates come down, you've just increased the number of people who can afford to buy that number of properties that's on the market. Like I said, it's less than 1 million. We've seen mortgage rates come down because what the Fed is doing is working. It's slowing the economy. And when the economy slows, people don't understand the difference between what the Fed is doing when they rate hikes versus mortgage rates. They're two different things. The Fed is raising overnight lending rates that banks charge each other when they're raising rates. That's what the Fed is doing, is not affecting us so much in the mortgage world, except to say that when the Fed gets what it wants to slow down the economy and fight inflation, mortgage rates go down. So it's the opposite of what you're hearing in the headlines, which is rates are going up. actually mortgage rates are going down. And again, that's confusing, but that's great for real estate investors, because if the world's confused, that again brings more opportunity. But when you had the banking crisis on top of that, to kind of show, whoa, there's some issues here. There's some fundamental issues. Well, then investors, big investors, flock to bonds. They buy the 10-year treasury. And when the 10-year treasury, when there's lots of investors buying it, the prices go up and the yields go down. And it's the same with mortgages. So to summarize that in, I don't know, much simpler terms, mortgage rates follow inflation. And if the Fed is fighting inflation and inflation is going down, mortgage rates go down too, regardless of what the Fed is doing when they're hiking rates. And every single time that mortgage rates go down even a little bit, you've got tens of thousands of people who now can afford to buy that home versus renting it.
I love that. That was such a good explanation.
Yeah, that was pretty clean.
How do you-
Thank you.
But how do you now, especially, I don't know if you've seen the news now, the adaptation from the entire world to stay away from the dollar. Do you think that that is going to affect the internal economy of the U.S.?
Oh yeah.
Especially with housing?
Well, it is a scary thing that the US dollar has been the world's reserve currency and has given us Americans an edge, shall we say. If the world is trading on your currency that you could just create, you've got extra power. So of course, the enemies of America, or just the competition of America, would love to have that power. And that is what we're seeing. We're seeing it with the BRICS nations, Brazil, Russia, India, and China, saying, well, let's take that power away. Let's just trade in our currency or in the yuan or whatever. Why do we have to trade in US dollars? The thing is, does Russia really have credibility worldwide? Does China really have credibility worldwide? Do most people feel that kind of trust in those countries? And the answer is probably not, especially now with what Russia's done. So currency is really just what's it worth? What's a piece of paper? What's a dollar really worth?
What we want it to be. It's a social
Exactly.
contract.
It's the trust in it. It's the trust that you're giving me a piece of paper and I have to believe that it's worth something and that it's backed by something. And most of the world still trusts America more based on our economy. Now, could it change? Yeah. I mean, he's a younger generation. You guys better, we're handing you a big mess, right? It's a big mess. I hope you can straighten it out. And the credibility of the U.S. it's still there, but it's on edge. But there isn't really a country that that the companies trust more, that a currency that companies trust more today.
Wasn't that the kind of the goal when the U.S. went off the gold standard? The Fed did that, was to be able to have the control and manipulate inflation or the value of the dollar at their will, rather than it being tied to gold.
I mean, I think there's so many different opinions on what happened there. I've heard opinions that we just simply didn't have enough gold for the amount of money we want. So, again, I wouldn't want to try to interpret that. What I do know, I still invest in gold. I still think it's important to have 10% of your net worth in gold, because that's just kind of a savings account.
Hold that gold, or is that like through a broker that you're purchasing the commodity?
We like to either have the real gold, but stored, in a safe place.
Okay, yeah.
But I don't like to buy gold stocks or anything like that. But to actually hold the gold, I wouldn't want to hold it under my mattress or something like that.
Yeah,
that wouldn't be
sure.
safe. But there are safe storages for your gold.
Okay.
And now going back to, we've talked about 1 to 4 units. What are your opinions on syndication and multifamily? Where do you see that going? Are we overextending with the amount of syndicators that are coming into the market? Because I've heard you mention that. And what are your projections for multifamily in the future?
I don't know that we're overextended in the number of syndicators. I think we have too many new and inexperienced syndicators who are going to be feeling some tremendous pain. So my first I guess, advice to anyone interested in investing in someone's syndication is make sure that that operator has experience. You know, obviously, if you're young, you're not going to have as much experience as somebody older, but there needs to be somebody on the team that is older and that has been through different cycles and knows how to deal with different challenges. So if you're investing in someone's syndication, just make sure there's someone on the team who has tremendous experience. I would also make sure, personally, I underwrite so many different multifamily deals that come across, our desk, and not one of them has passed our muster, not one, because there's just too much optimism that rents will continue to rise. They're not right now. They rose so much over the past couple of years that they're just going to kind of hold steady, and in some areas they're dropping. So there's just been overly aggressive underwriting, not enough reserves being held. These floating rate debt. There we go. Adjustable rates that are risky. It's just risky to do that. So I would just prefer to be in a low leverage type of fixed rate deal. That's me.
I see what you're saying.
With that said, if you're a risk taker, I know that there's people who still have been able to pull it off. I don't think multifamily has found its bottom yet. I don't think that it has stabilized. So I personally am going to wait another couple of quarters, probably till the end of the year, to see if we really understand where cap rates are, to see the deals come. There's going to be a lot of distress, and those deals won't be on the market soon, but probably by the end of the year. So personally, I would wait, but this would be a really good time to learn it, to do your studying, to understand it. If you're going to be a syndicator, please don't syndicate if you don't know what you're doing. There has to be someone on the team who does that. That's the bottom line.
Or just be an LP. Don't be a GP. Just be an LP if you ain't got no experience.
Exactly. Or, this happens to me all the time. I'll be at conferences and someone will come up to me and say, "Oh, I hear you're a syndicator. I want to do that too." And I'm like, "Great. What's your experience?" "Oh, I don't have any." Well, then get that idea out of your mind. I don't know who gave you the idea that you could be a syndicator. Your job is to go buy your first property.
Yeah.
If you haven't bought a property and don't own a rental property, don't you dare take other people's money. Like, no way.
That's my same advice. I tell that people all the time, and they're like, "Well, how do I do my first deal, but I don't want to use any of my own money?" And I was like, "Well, first off, like that's a terrible idea, because then if you're using private money, you're going to burn those bridges. If you do want to do a deal without, at least have it be a hard money lender so that they do their own underwriting to double check your first swing in real estate. Like, stay away from using other people's money in the beginning."
Yeah, the only way I would say that somebody could do that is if they were an incredible marketer, right? But their partner is an incredible real estate investor. That's the only way. I know when Joe Fairless started, that's how he started. He was a marketing guy from New York, but he had a partner who was a really experienced real estate investor, so they were able to team up. That's different. But if you're just trying to do it on your own, look, go learn wholesaling, go learn subject to, there's ways to buy property with no money. But until you've got experience, please don't take other people's money.
What are those hard-earned lessons that you've learned? Well, that sounds redundant, but those lessons that you've come across with cycles.
With cycles, I mean, I got absolutely destroyed in 2008. It was a really, really hard time. And I would say what I did wrong was just not having enough reserves set aside and not having enough cash flow. So we took risks in building new homes and buying properties that we really thought were in the path of progress. And it was like, okay, it was in California, so, California prices always go up. And so I'll handle a little negative cash flow until prices go up. That was the attitude, the California attitude, because over the years, it has worked, but you have to hold that property. So there was a point where we were about $10,000 a month negative cash flow in 2008. And we just kept trying to feed it. And finally, we're just like, oh my gosh, we had to short sale some properties. We had someone into foreclosure. And it was super embarrassing because I already was a pretty well-known podcaster and, owner of Real Wealth and teaching people how to get cash flow. And here I was getting negative cash flow, and it was just so difficult.
Well, but would you say now that because you went through that, you can teach that and tell people to not make your same mistakes?
Yeah, absolutely. That's why I say things like, make sure you've got plenty of reserves. Make sure and have a fixed rate. We live in a country where you can get a fixed rate mortgage. This does not exist in any other country. I just did an interview on the Real Wealth Show with some Canadian investors, and I know it from working with many international investors. They don't have fixed rate mortgages. It's always adjustable. So the fact that we have that, like, take advantage of it. It's really rare. It's really special.
Yep.
Wow. Thank you so much for coming here. I appreciate you accepting the invite. The Bigger Pockets, you throw bombs of information. This was really useful. For everybody
Thank you so much.
For everybody that is listening and everybody that has any questions, we'll leave all the links below to hear more concepts about cycles, Fed, new trends, anything that we left on the table that you think that is very important we mentioned before we go.
Just know that it's times like this where you can create tremendous wealth. This is the market. This is the time. So do what it needs to take. If you don't have any money, learn how to wholesale or do the subject to. That's how you get in. If you do have money, you don't have competition right now. You can buy assets at a discount, and you maybe are going to be in a higher interest rate, but eventually rates are going to come down because rates follow inflation. You can just refi into a lower rate. But as soon as rates go down, there's going to be competition. So now's the time to buy, refi later.
Now it's the time to buy. Thank you so much for listening, and I'll see you on the next one.